Today I'm going to be talking to you about various types of charitable donations and the deductions and the limits that follow. Charitable donations and the deductions have been around for a long time. The charitable donation deduction was first introduced in the 1950s, and to a large extent has remained unchanged since then. What I'm talking to you about today is these are tried and true deductions. These are not cutting edge. These are not unique. These are not new. These are not listed transactions. These are just IRS approved charitable donation deductions. This is Rich Hoffman with Jesani Advisors. I am a senior advisor here, CPA, tax attorney, many decades of experience. And I've got some really cool tax topics I'm going to be talking to you about today. This video is intended to walk you through the various types of charitable donations and the deductions that might be available to you. The first couple that I'd like to talk about are typically referred to as CRUTs or CRATs, Charitable Remainder Unit Trust or Charitable Remainder Annuity. Both of these have a unique aspect in that when you put into those trusts appreciated property, you get a charitable donation deduction based on an estimated amount that's going to remain at the tail end of the investment period, typically 20 years or more. The amount of deduction that you get is limited. 30% of your adjusted gross income is the maximum limit on the amount you can deduct in the current year. However, if you donate a significant amount of assets to a CRUT or a CRAT, and you hit your 30% limit, the excess can be carried forward for up to another 5 years. So essentially you have 6 years to use the deduction, the year of the donation plus the next 5. The other large difference between a CRAT and a CRUT is a CRAT provides a fixed annuity to you based on IRS tables. The CRUT, however, that annuity, that cash distribution to your heirs is going to go up or down based on the performance of the assets in the trust. So the next type of charitable donation deduction, or at least charitable donation deduction vehicle that I'd like to talk to you about, is something called a donor-advised fund. How a donor-advised fund works is you typically move appreciated property irrevocably into a fund. It's invested and grows, and you get to designate which charity gets those assets and when that charity gets those assets. So the benefit of this is you get to deduct as much as you've put in appreciated property. You can deduct up to 30% of your adjusted gross income in the year that you've made the donation. Much like some of the other vehicles we've talked about, if you donate, if you move appreciated property and it's more than 30% of your adjusted gross income, that excess piece can carry forward for up to another 5 years. So essentially you've got 6 years to use that donation, the year of the donation plus the next 5. What's great about a donor-advised fund is you get to pick the charity and you get to pick the timing. The downside of a donor-advised fund is you move that money. Yes, it's outside of your estate, but it's also outside of your use. It's irrevocable. Once the money's gone, it's gone. You get to determine what charity it goes to, but it's inaccessible by you or your heirs after that. A great example might be somebody who has a very, very large amount of restricted stock units that have vested over time, and that stock has really, really, really grown. Say NVIDIA, your cost basis may be $100,000 and it may be worth several $1,000,000. A good strategy might be moving a piece of that into a donor-advised fund and reducing your taxable income by the charitable donation deduction in the year that you move it. So you avoid the capital gains tax and you get a fair market value deduction. So you could reduce your taxable income by up to 30% in the year that you move that NVIDIA stock to the donor-advised fund. The next charitable vehicle I'd like to talk to you about is a private foundation. A private foundation is where you essentially ask the IRS for charitable status for an organization that you've created. Now, there are a handful of rules associated with a private foundation, rules that are critical that you follow. The first is that 5% of the total assets placed into that private foundation are distributed to charity every year. There are also very, very strict requirements in terms of self-dealing. Frequently, you will see on the internet unscrupulous tax people who might tell you you can hire your children and pay them as part of this private foundation. And while to a certain extent that is true, the point of a private foundation is to move the money to charity. And to the extent that you've moved money to your children instead of charity, the IRS takes a fairly strict outlook on applying the rules and could essentially claw back your charitable donation or even your charitable status altogether. The fourth and perhaps the simplest way to get a charitable donation deduction is simply by donating something to charity directly. You're not using a private foundation, you're not using a donor-advised fund, you're not using a trust, you're not using an investment. You simply donate to a charity directly. If you donate cash to a charity, the first thing you want to do is make sure they're a qualified charity. If you go to the IRS website, there are going to be links where you can check on a charitable status. You're going to want to make sure that they have a current determination letter, which is where the IRS grants them charitable status, and they're current with their tax return. If you donate cash to that charity, that 501c3 charity, you're entitled to a deduction up to 60% of your adjusted gross income. You could, of course, donate appreciated assets, stock, or something else. Those are typically called in-kind donations. Those assets are typically what are called capital gain assets, meaning they fit the definition of a capital asset under Section 1221. The critical thing here is you have to have held those assets for longer than 1 year. Those in-kind donations, to the extent that you are donating appreciated stock, you avoid capital gains on that stock, and you get a charitable donation deduction equal to the fair market value of that stock. If it's not stock, you're donating other types of appreciated assets. There are a handful of requirements. If the value exceeds $5,000, you need to have the item appraised. The second rule in place is the charity that you are giving the item to has to use it as part of their exempt purpose. So, 1, appraisal. 2, the charity's using it as part of their exempt purpose. If both of those boxes are checked, you're entitled to deduct the fair market value of whatever you've donated to that charity. If you don't have an appraisal, there's going to be a problem. So an appraisal is critical in order to validate your charitable donation deduction. Form 8283 is typically used when you're donating something of appreciated value to a charity that's using it as part of their exempt purpose. That Form 8283 is typically signed by the charity, and it's also signed by the appraiser. You attach that Form 8283 to your tax return, and you are entitled to a deduction. The limit is the same as the limit for donated stock, and that is 30% of your adjusted gross income. Much like the other charitable vehicles we've talked about, if you happen to donate more than 30% of your AGI, adjusted gross income, that excess piece carries forward for another 5 years. So we've talked about various vehicles and donating to charity, and there are a lot of different flavors and a lot of different forms. In additional nuance to that, one can use a limited liability company as a vehicle to move appreciated property to a charity. There are a couple steps to this, and it's a little more complex, but again, the laws really don't change whether or not a person is donating to charity or an LLC is donating to charity. The critical thing here is the person that has the appreciated assets contributes it to the LLC in exchange for LLC ownership interest. A couple cool things happen. That is governed by the partnership law of the Internal Revenue Code. And while you would think the LLC has to hold the assets for an additional year after it receives them, under Section 723, the LLC actually inherits its holding period from the person that contributed the asset. So if the person that holds that appreciated asset has held it more than a year and donates it to an LLC in exchange for LLC ownership interest, and that LLC then later contributes to charity, even if both of those things occur on the last week of the year, the LLC is deemed as holding those assets for longer than a year. Now, typically, when that occurs, you've got a third party involved as well. Somebody who wants the charitable donation deduction and is willing to put some cash into the LLC. So again, what happens? Person with the appreciated assets contributes them to the LLC in exchange for interest. Somebody with cash puts the cash into the LLC in exchange for LLC ownership interest. Then the LLC donates the property to charity. When the LLC files its tax return, all of the owners are going to get a Form K-1, and that Form K-1 is going to tell them their portion of the LLC's donation to charity at fair market value. The second document they're going to get is they're going to get Form 8283, where the LLCs hired an appraiser to appraise the assets. The appraisers signed that Form 8283, and the charities signed that Form 8283. Why this works particularly well is it allows one party to share a charitable donation deduction with another party. Much like individual donations of appreciated items, there is a 30% limit for a capital asset that is donated to charity, an appreciated capital asset donated to charity. So even though you're using a limited liability company, that 30% still applies to you. So we've talked about a number of charitable donation deductions and vehicles today. If you're looking for something specifically tailored to your situation, I would encourage you to visit us at our website below, where we can help you determine what is most appropriate for you today.